Welcome to Harbor Rock Wealth Management's Planning Tip of the Week. My name is Ruben Smith, and again, I am joined by my good friend and partner, Jimmy Luster. Thank you for joining me.
Thank you for having me. This is becoming a regular thing.
Yeah, I kind of like it. You bring up some good questions and some different spin on things, so I enjoy having you in here.
Well, it's not even four eyes, it's eight eyes.
Well, we got 8 eyes on it, yeah.
Two guys with glasses. So, yeah, I'm glad to be here. This is a lot of fun, and I'm glad to be back.
All right, very good. Well, any stats of the day for us, or is
You
this
know that I
okay?
do.
Okay.
You know that I'm coming with some stats of the day anytime I'm on the show. So, a couple of good ones today. One's kind of funny. I'll save that for the second one. But the first one, so Cal Ripken, also known as the Iron Man in 1995 on this day in sports history, broke Lou Gehrig's consecutive game record.
yeah.
I believe it's 2,136 games,
Okay.
which is absolutely incredible.
Right.
And you brought it to my attention. So that's 95. I don't think he retired until when? 2001, you said? Right around then? Early
2001, yeah, because that was when we were on the baseball trip, and I remember seeing him a few times. And one game in particular was in Atlanta, and he actually hit 2 home runs, and he wasn't really known to be a power hitter. So that was
No, he
that
was a
pretty fun.
gap-to-gap guy.
Yeah, really
But
cool.
so after playing that many games, and we talk about retirement with our clients quite a bit, you think it might be time to bronze the spikes, as we say, and maybe grab a popcorn and a hot dog and watch some games? No.
Not so much.
Cal pushed on for a few more years.
Yeah,
Played in an All-Star game, I believe, hit a home run in his final All-Star game. So.
retired with Tony Gwynn,
Tony
one
Gwynn.
of my personal favorites.
Oh yeah,
Yep.
oh yeah, incredible hitter also. And then one that I thought that was funny: the Pittsburgh Steelers were not allowed to practice on this day in sports history at their own field because the Rolling Stones were getting ready for a concert.
So they must not have been very good at that period because they had
Yeah.
no pull to push the Rolling Stones off the
Yeah,
field.
you're literally kicked out of your own house for a band, just some band.
Just some band.
Just some
Okay.
band,
Well,
so.
I'd beg to differ there.
But anyway, yeah,
Okay.
good stuff today. Yeah,
Very good. Well,
Yeah.
appreciate you joining in.
sure.
This week, we are going to be discussing some tips for short term investing. This has been coming up quite a bit of late. I shouldn't say of late, maybe over the last year, as the Fed has continued to raise rates and making short term investment vehicles more attractive. So,
Okay, yeah,
we're going to discuss some tips on that.
sure. Yeah, it sounds good. It's definitely relevant. Yeah.
Very good. So I typically break, when it comes to short-term investing, I typically break it into 2 different subsets, if you will. One would be more of an ultra short time frame. That's going to be anywhere from 1 month to maybe as long as 2 years.
Okay.
And then the second subset would be more traditional short term, which is 2 to 5 years. The key with either of these is that you want to focus on safety. I think safety is going to be first and foremost. You don't want to lose the asset. If you're putting this to work in any type of investment vehicle, you want to make sure that it's there when you are needing it.
Sure.
And then also setting the right expectation. So we got to keep in mind that these are short-term vehicles, right? So we can't expect that if we put our money into, let's say, a 1-year CD or 18-month CD, that it's really going to do all that much for us.
Well,
right?
it's safe to say that the more predictable an outcome, you're probably not getting as high a yield, right?
Exactly, yeah, and that's something we always say: is the shorter the time frame, the more unpredictable the results. So if you have 6 months until you want to buy a car, you don't necessarily go put it in the stock market.
Yeah,
right?
like it would be more, probably a lot more fun to go play a slot machine in Vegas with $100 or.
Yeah, it'd get your heart going. That's for sure.
You know, if you're looking for a big return, definitely not in this case when you have a purchase on the horizon.
Right, exactly. So then the other thing when it comes to short-term investing is make sure that you're selecting the right vehicle, and you're making that selection based off what your specific need is. So if you know you have a liquidity event coming up or a need for this money, but it's not determined when, you're going to want liquidity, right? So you want to make sure that if that time comes, that you have access to it without any penalties or restrictions.
Sure.
Whereas if you know that you have a specific amount of time until these funds are needed, then you can go into something maybe with more structure and hopefully a higher yield, like a CD vehicle or something with more parameters.
So even though these are short-term vehicles, as you're saying, strategy is still of the utmost importance here in realizing not just time horizon, but more what personal need that you have and what it is that you might be purchasing or have a debt due or something like that.
Exactly, exactly. And it's when you start looking at what some of these shorter term vehicles will pay versus maybe what's going on in more longer term markets like the stock market,
Mm-hmm.
it can be enticing to maybe push the envelope a little bit with risk, and I'd be careful with that because a little extra risk or a little extra return, if that's what you're seeking, might not be worth the underlying risk.
Sure.
So just be careful. The goal here is to get a little bit more than what you started with, not end with less than what you started with.
Sure. So, me included, especially with our time at our previous firm, I got that question all the time, like, just have my money in a checking account, and I feel it's safe there, and there wasn't in that environment. There wasn't a lot of other options.
I was going to say, very difficult for you to.
So that might
You want me
be
to pull
that
the
moment.
CD rate sheet? I'll show you.
Sure. Should I get 0.10 for a 10-year CD or 0.0 nothing, as we called it, in a checking account? I'd keep it straight up in a checking account. It's more flexible. So that might be an example of that.
Exactly, exactly. And then the last thing to consider is that not all short-term options are created equal. So kind of tying back into making sure that you're selecting the right vehicle for your short-term needs. So I think we could segue that into the different types of products out there.
Yeah. So what's out there? What's available?
So let's start back in your world, right? We'll go back to the
bank world,
the brick and mortar bank, and just your classic checking and savings accounts, right? Checking account, always liquid. Savings accounts, always liquid. FDIC insured, very safe. They allow you to sleep at night.
Right.
Unfortunately, especially with the larger banks out there, you're not going to get much of anything from a yield or interest rate standpoint.
And I think it's most of the larger institutions that's still the case from what I'm seeing.
Right.
You say, well, what do I do then? I still want that type of a product. Is there anything else out there? Well, you're probably looking at something online at that point, most likely. Maybe an institution that still is trying to attract deposits.
Right.
So they might offer a little more incentive there.
A teaser rate.
Sure. Yeah.
So staying in FDIC, there's also high yield savings. There's all sorts of catchy names.
A lot of different marketing names,
maximizers, and all sorts of stuff. But essentially, it's a higher yielding savings account. All the FDIC still applies. However, oftentimes they require a certain deposit balance.
Sure.
So you have to keep a certain amount of money in there to get a higher yield.
Or they only allow you to put so much in, or they only allow you to pull so much out at a time. Yeah, you definitely want to look into the details there.
Read the fine print.
You can get stuck in the minutia and not be very happy with the outcome there.
Exactly.
You got to understand your product.
Right. And so that brings us to CDs. So we know what CDs are, and everywhere you look right now, it seems like CDs are paying pretty attractive rates.
Sure.
Right? Whether you hear them online or you just walk into your local bank, everyone's got these attractive rates. Now, be careful with CDs, right? They do provide that FDIC safety blanket. However, their specific terms do apply, right? So if you buy a 6-month CD and come in at month 5, there's a chance they could penalize you, or
details.
It could not end up with the best experience, right?
Sure. Yeah.
So, but in order for you by you locking up your money, so to speak, for that certain term, you are expecting to get a higher yield than what you would get in a savings account. If you're not necessarily certain on what your time horizon is, you may want to consider laddering some CDs too, which means you take different maturities of CDs, say 3, 6, 9, and 12 months.
Okay.
And you break it up, and then that way, every 3 months, you have a CD coming due, and you can decide if you need the funds or not. If you don't, then you go back out further and buy another 12-month CD.
Okay, and that would be as opposed to buying a 12 or an 18-month CD or something.
Yeah, I mean, it's set in stone. You know what the outcome is. The laddering gives you a little bit more flexibility when that money's coming due. It also helps in a changing interest rate environment help fight against interest rate risk.
Sure.
So,
okay. Great tip.
So the next level of investments for short-term strategies would be money market accounts.
Okay.
So money market accounts, I don't want you to get confused with money market funds, which will be next. So money market accounts are bank issued. They are 100% liquid, and they are FDIC insured. A money market fund typically is not FDIC insured. A money market fund is a mutual fund where the portfolio manager goes in and buys short-term debt instruments. So
Okay.
whether it's treasuries, corporate bonds, municipal bonds, bank notes, but you're not getting the FDIC protection in there, even though they are still very, very safe instruments because they're ultra short-term. They're 0 to 3 month durations typically.
Okay.
Okay.
Yeah.
The only chance that you could have some significant losses inside of a money market fund, not a money market account, is going to be when we have when there's a significant economic decline,
Okay.
and typically when it's unexpected. So we had a 9/11, we
Sure.
had the financial crisis. Anytime there's a big run on the economy, that's when
Okay. It's good to understand
you
that
can have a
risk.
run on these money market funds.
Yeah.
Okay. And then the last strategy I want to talk about is treasuries. We hear a lot about, oh, you can go out and get a 2-year treasury for 5%, and that's, the risk-free rate. And yeah, that's great. That's exactly what they're paying right now. Some specifics on treasuries is that they are not FDIC insured. However, they are backed by the good faith of the U.S. government, which I think is still pretty solvent.
I think in this case that's a solid
Okay.
application there. Yes.
Okay.
Yes.
So there's all sorts of maturities with treasuries as well. You can go very short term, all the way to 30-year debt if you wanted to, and a different varieties there for you to choose from. Now you can buy these a couple of different ways or invest in them a couple of different ways. More and more, it's becoming the standard to go directly through the Treasury's website, which is treasurydirect.gov. You can also hold them in brokerage accounts. We offer clients treasuries as well, and we hold them here in brokerage. Now, the advantage there is that it's all under one roof, and you have one point of contact to get some consultation on it.
Yeah. So it seems like the last, like we said, 12 to 18 months, we've seen a lot of these solutions that you're talking about get more and more competitive.
Mm-hmm.
And, I all eyes still on the Fed and
Right.
rising interest rates. And obviously these products and solutions getting more competitive during this time frame are a product of that environment, of a
Right.
rising rate environment. Where are we headed in the future?
And
will these solutions still be viable?
Yeah, that's a good question. I think first of all, no one really knows. I think we have a hunch that rates are pretty close to plateauing.
Okay.
How long the Fed pauses on rates, nobody knows. But what's going to happen for those that are chasing returns right now in these types of vehicles and getting their 5 or 5.5% is that the minute the Fed pauses and the market buys that they're actually pausing, the next move for the Fed will actually be to the downside more often than
And
not.
how quickly would that take place?
Well, that's really to be determined. It really just depends on how long what shape the economy's in and how long it takes to start slowing down to a point to where they need to lower.
Sounds fair.
But what I'm getting at is the minute the actuaries in the market buys that the Fed's actually paused on their rates, you're going to start seeing these short-term rates that are being offered now drastically decrease. So they're not going to go back down to zero. I don't think we're going to go back down to a zero rate environment like we saw a few years ago. But 5% in a 1-year CD might not be available in 6 months. Okay. So keep that in mind. If you do have a shorter time horizon and maybe 1 or 2 years and you want to lock in one of those rates, the more competitive rates today, maybe you would consider a CD or something that's not variable, that's a fixed rate.
Sure. Well, this is awesome. And while right when we sat down here and we were going to discuss this today, we advise our clients, and I think people are so set on thinking about the distant future, and long-term investments. And you hear investing and you think right away, long-term. It's a long-term play.
Right.
I'm investing to fund my retirement, or leave a legacy. And we look so far off into the distant future, and we often say, don't look too close, and have the blinders on and get stuck with what's happening right now. Well, this is a case that in the environment we're in, we really need to do that. Having a strategy, for these short-term investments is more important than ever. But just as fast as they've come here in this volatile environment, they might vanish, and you need to have a plan to make an adjustment and pivot.
Right. Yeah. You go back a couple years ago, there really wasn't much of any options. Everything was paying less than a quarter point.
Yeah.
I mean, it was really dismal for those that were, I call them in the FDIC world as far as investing.
Yeah, right.
It was really, there was no other options.
There's nowhere to go. Yeah. Nowhere to go.
Now, fortunately, there are options, but that can also be debilitating. Once you have options, okay, well, now what do I do? So we're actually seeing clients still in cash, even though that's paying far less than what they can get, even though there's much more options out there.
So once again, do something. Have a plan.
Do something.
Do something.
Even if that means just having a conversation with your advisor, or giving us a call, and maybe cash or in a checking or savings is actually where it needs to be based off your scenario.
Again, having a plan is the best plan in this situation. Well, thanks. That was awesome.
Yeah.
I appreciate you.
My pleasure.
Yeah, giving us some information on that.
Absolutely.
Great.
Well, if you have any questions about any of these topics or products, feel free to reach out. And we appreciate you watching in, and we'll see you next week.